Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the Econ Show, we have a decent amount to talk about just based on the plethora of data that came out, especially in the U.S. So I should say the U.S. and Europe. So we'll cover that, and we'll try to go through things quickly just to keep things flowing, just because there is a lot of data out there today. So we're going to break it into our normal 5 segments. So in the first segment, we want to talk about global stagflation and how we're starting to get kind of this peaking of the inflationary curve, but really not deflation, but really this stagflation starting to really crop up in some key areas. And we want to talk about how that plays out, because we do have some inflation in some emerging markets that's continuing, but we also have some areas that are already starting to see that stagflation, which again is going to kind of neutralize some of the emerging market inflationary pushes. But we'll talk about that in a minute. Then when I had a great question, because somebody asked me, what does deflation look like? Is the bullwhip, as it's been described, going to create this rapid deflation? And the bullwhip impact is you had a huge shortage of inventories. So companies are going to overpurchase. So then you're going to have a huge surge in inventories just as demand is collapsing, which is actually going to bring prices down, not up or stagnant. And we've talked about ways on why we think that's going to be stagflationary, but I think it's a good time to revisit that and really look at why we think stagflation is going to precede that deflationary drop and what's going to be the driver of it. Now, one of the key things that we want to talk about in segment 3 is a lot of the leading indicators are showing contraction now, or showing that contractionary push. A lot of things are already negative. We just had the Atlanta GDP estimate come out. It's now at -1% for Q2, so they're already starting to show some slowdown for Q2. Again, we do think there will be enough growing pieces to avoid a negative Q2. Again, we could be surprised to the downside, though, as people assume I'm very bearish. That would be shocking. But again, we do think that we will get that in Q2, that growth in Q2. And then when we look at Europe, the economic data is starting to now catch up to what we've been talking about, where it's just getting ugly. And the inflation side is starting to crest a bit, still going up, but again, slowing in rate of change, but you're starting to see the detriments on the economic side. And now China data showed a bounce, and we want to talk about will it last? It's not, we don't think that obviously the rate of change is going to last, but we do think that they're going to bump along around the bottom, as we've been talking about. But because they had such a steep drop in activity that was so prolonged, they still have their COVID zero policy. You need more than just bumping along the bottom. You need a surge higher to make up ground. And that's why we just don't think their estimate is, or their target is feasible at this point in time on economic expansion. But we'll go through that when we get to that point. And then we're going to follow on with South Korea and Japan, especially with Japan following the yield curve control that we've been discussing. So now when we turn to some of the key areas when we're looking at the global economies, and so one of our analysts, Osama, found this chart from S&P Global. Asia Pacific economies grapple with ballooning energy crisis. And now he's in Pakistan, and he's been talking about how inflation is crazy, costs are up. It was 49 degrees Celsius there. And so, I mean, you're looking at AC burning constantly, but we have a middle distillate problem. For those that have watched our EIA show, there's a shortage of diesel. There is a shortage of things in the world that is needed for power gen in these areas. And for those that have been watching us, we started the private equity fund back a few years ago. And our view in 2019, when we were coming up with our investment thesis, was we were going to have a global shortfall of energy infrastructure. There was going to be a shortfall of baseload electricity capacity. There was going to be a shortfall of diesel. There was going to be a shortfall of food. And these are things that were really the key pillars to how we were going to invest, to address these issues. And we're watching it play out here. When you look at thermal coal prices at elevated levels, and it's because you've had to turn coal back on. We've taken down a significant amount of base load capacity, relying more on peak shaving and peakers. Now, that's great for intermittent use, but as you're using more and more of these peakers almost as base load, where you're losing the ability to peak shave and to bring on capacity, which is resulting in rolling brownouts and resulting in consuming a significant amount of fossil fuels, because the green side is just doesn't have the energy density at the moment. It could change 20 years from now. I'm not saying it can't, but at the moment, they do not have the ability to do that. And this is creating and propagating more pressure, more inflation, because this is all getting passed down to the consumer, which is why this specific area we do believe is going to have more inflationary pressure. And it's only going to get worse as some of the subsidies are set to expire at the end of June. And as those subsidies go away, that's obviously going to bring more cost down to the consumer. Now, some of the other things that are going to continue to make things worse is the flows of natural gas to Europe from Russia. So as that goes down, well, now you have Asia, you're going to have Asia who's bidding for LNG. You're going to have Europe that's bidding for LNG. And now you're going to start to see this pressure point where, it's going to go to the highest bidder. And if you can't get it as the highest bidder, well, where are you going to go next? Well, then you're going to go to ultra low sulfur diesel. Well, as that gets priced out, especially in the Pakistan and ASEAN nations and Central Asia of the world, you're then going to go to fuel oil. And again, you're going to see these pressure points as they get priced out, which is going to increase the pollution side. If you think about high sulfur fuel oil and other types of means of power gen, all the while as Europe continues to pull more aggressively from the LNG side, as Russian gas continues to diminish. Now, when you start looking at, well, what are people searching for? Well, people are shockingly searching about what is a recession? Is a recession around the corner? Because they're seeing it in the news there, but it's not just the news, because when you look at it, you could say, oh, well, everyone's telling me this. People are feeling it. They're seeing it firsthand as their wages aren't keeping pace with the rise in pricing. And so that's going to adjust demand. But there are net shortfalls when you look throughout the commodity world. This is tin, this is zinc, this is copper, coal, natural gas, LNG. You're seeing some of these pitfalls where you're just not seeing the same type of supply response. You are seeing that demand degradation across the world in a lot of these key areas, and we're going to talk about global trade. But you're seeing some of this capping action, which is why we see more of a stagflationary backdrop and less of this big stark deflation pressure. We do think we get deflation. That is 100% what we see coming. And for those that have been watching us, we had said that this decade was going to be a weird amalgamation of the 30s and the 70s. And that's where we are right now. Like, we're seeing this inflationary push. It's going to give way to stagflation, and you will see that deflationary drop. It's just we don't think it's around the corner, but something that's going to happen much further into 2023 versus right now. And here are some of the key components of why. So food prices have mostly obviously been on the rise this year. And though some have fallen year to date, but key staples like wheat have continued to soar. And now, again, it's off the peak. Excuse me. And that's the key piece. It's off the peak, but it's not dropping. It's just not going up anymore. So you're getting some of that stagflation pressure coming in. And it's always the replacement side. If I can't get fish, I'll get chicken. If I can't get chicken, what am I going to get? Am I going to get soybeans? If I can't get soybeans, I'm going to get wheat. If I can't get wheat, can I get corn? Can I get rice? You're always going to see the replacement aspect because people need to eat. I mean, this is a very simple thing. I'm not reinventing Maslow's hierarchy. This is a huge component of it. When you look at shelter and food, And when you look at those two together, you get some of these pressure points, which again is going to keep things very elevated. And we have a chart on that housing side in a moment. But when you look at the U.S. in general, U.S. being one of the largest components of especially wheat production, wheat yield, as well as other pieces, here are some key components. Well, when you look at this week's drought monitor, shows a big marked expansion of dryness in the eastern belt, Illinois, Indiana, mid-south, and the Delta region from the previous week. So dry conditions now cover 58% of Illinois and 88% of Indiana, both the most since October of 2020. So you need to see that start to adjust. And then when you look at the new USDA release, when you're looking at what was the expectation, well, on the corn side, the expectation was for 89.8, came in right there. Soybeans came in less, was expected at 90.6, came in at 88.3. Wheat came in at 47.1. And to be clear, this is the second worst wheat expectation in history, to give you an idea on some of the pressure points, which again, it's even though, and to talk about Brazil for a moment, Brazil's having a bumper corn crop. So the corn crop is doing very well there. So it's not a universal thing where things started out fairly weak. They've caught up on the corn side in specific areas, but they're also because there's not enough silo space. Corn is piling up next to the silo. And can they get it to market given the supply chain issues and whatnot without rot? Brazil has always had an issue with rot and losing some of their yield, but again, having the bumper crop will help insulate that. But other areas are seeing those shortfalls. We're continuing to see the problems within Russia and Ukraine. And as we said in the EIA show, there was an errant sea mine next to one of the CPC moorings in the and so. Okay, well, can you get an errant mine in some of these areas? And that's where you start to see that pressure point. Now, the other component is the world economy is now rapidly heading back into a recession. And when you look at the global headline sales managers index, we are now in contraction. So this data is showing that on a global basis, we have now slipped into a contraction. It doesn't mean that we're instantly in a recession. That is not what I'm saying. It's just the trend, which has been bumping along the bottom, has now turned negative. And again, this is going to propagate more problems. This is going to decrease more demand. But as the demand decreases and you still have fairly low supply on things, yes, you're going to get prices capping, but not falling until you start to either get that supply response or you see demand fall even further. Now, inflation surprises continue to move to the upside, especially in the emerging market front. So again, it's not over. The developed markets have already seen that huge push on the inflation side, but emerging markets were insulated a bit because of the subsidies, because of some of these components that they were the last to see, and now you're starting to see that final leg, which again is going to be that tailwind to the inflationary global pressure, and they're going to push that through and try to recover as much price as possible, again keeping some of those prices a bit elevated, which would be again another underlying problem. Major advanced economies interest rates, this is the other piece, is you're just seeing more and more interest rate rises with expectations and forecasts going up as countries try to get in front of the inflation, try to get in front of all of these key pieces. And again, how fast do they go? And depending on the speed in which they go and how tight financial conditions get, this will also dictate how slow the local economy, global economy gets, because if you can't access capital, you will cut capex, you'll cut jobs, you'll reduce some of your activity, which again would also lead to some of that slowdown. But when you look at the gauges of property risk for OECD members and ascension countries, you get an idea on where this risk is and how a lot of these countries at the very top end on the risk profile, I mean, the US is number 7, Canada number 5. You're looking at big countries, Germany 12, Japan 18. This is a large problem that is not beholden to just the US. So when you look at the great financial crisis and the knock-on impacts, we expect to see something similar. And somebody had made a comment on Twitter about how, this isn't 2008. And no one's saying it is. It's just, I think the Mark Twain quote, which is the most famous or one of the most famous ones is, history doesn't repeat itself, but it rhymes. So it'll rhyme. It'll look similar. It doesn't have to be exactly the same. There'll be a lot of similarities, but the drivers will be different. The way we react to it has to be different. And this is, again, something that is showing housing is a big piece of it, but it's not going to be the only driver at this point because of the supply side issues, because of some of the inflationary pressures that weren't as prominent in '08 as they are today. They were prominent. I'm not saying that they weren't, but they weren't to the same level as they are today, or at least the same stickiness that we're seeing at this point, especially on the food side and especially on some of the other key drivers and tailwinds to inflation. So then when you start looking at the OECD house price ratios, United States price to rent, you can see 2008, which is that peak, and now you can see where we are. So U.S. house price to rent ratios measured by the OECD has gone parabolic throughout the pandemic, is at an all-time high, and has blown through the top of that '08 recession. So you're already starting at a higher level, which is why, again, it'll look similar, but it's not going to be the same. And so that's why you have to look at all areas to ensure we're seeing the right things. Now, the U.S. is obviously the biggest high-income country and predictably also the least dependent on trade, because 70 to 72% of our GDP is dictated by the local consumer. But when you start looking at advanced countries ranked by population with the averages for top 10 and others, you get an idea of how beholden some of these nations are to trade. When you look at Taiwan, when you look at the Netherlands, you look at Germany, there is a lot of capacity that has to be watched when you're looking at trade. And as a global slowdown really starts to pick up and trade starts to diminish, which we've already seen, these are the countries where they were really relying on exports, and that was driving some of their growth. And that last beacon of hope that is really, or that last pillar holding up their economic expectations, is now starting to come down, and that will also bring down those expectations. And with China as a crucial trade partner for a lot of developing economies, as China continues to have its spits and starts with zero COVID policies, local consumption issues, slowing trade in general, you're going to see that knock-on effect, which is going to put even more pressure on places like Indonesia, Pakistan, Vietnam, Nigeria, where you have to look at how China impacts them, Brazil as well. And the US, EU is obviously going to be a big piece of it. And they're just going to get hit on all fronts, because China was really the saving grace for many different periods. And when you look back through 2008, China always came to the rescue with stimulus and spending and taking advantage of, and we're just not seeing that same capacity. And the PBOC made a lot of comments along those lines, which we're going to talk about in segment 5. So then when you look at container freight benchmarks, you can see that there's a change in shipping trends. The rate to ship a 40-foot box from Shanghai to LA has fallen for the past 13 out of 16 weeks and is now about 30 to 40% cheaper. And again, like the cost of shipping has come down, but the stuff in the box also has been maintaining some of its price, but even that's starting to come down a bit, which we'll talk about in segment 5. Now, world trade volumes have flatlined. It ticked up slightly, but not enough to reverse the move down in March, meaning the index has largely gone sideways since the war in Ukraine broke out. And again, it goes sideways, then it starts to roll. And one of the things that we've been talking about for Q2 is it didn't just drop off a cliff. Like, we're not going to get that yet. That will happen. We will get that, but it starts gradual, and then and that's why the stagflation sticks here. This is where the stagflation is, and as that you get these big drops like we had in 2008, like we had in the beginning of 2020, that's where you get that deflationary driver. And you can see we're just not there yet. We're getting closer, but this is measured in quarters, not days, weeks, or even months. And that's why it's important to look at when is some of these impacts really going to drive home. And that's when you start looking at the global supply chain pressure index has come down, but it's still elevated. It's still at the high point from 2020. And these are some of the issues that we're continuing to see is it's come down off the highs, but we don't see it continuing to fall through a floor and come to a normal level that we saw in, or even the peaks of 2018, 2019, but rather remain at these elevated pressure points. So then when you start looking at, well, why? Well, let's start talking about shipping. The global fleet age. As of May 2022, the average ship is 21.8 years old. When you go back through 2005, you can see it's the oldest we've ever had. So will we get scrapping? Are we going to get new vessels? When you start looking at bulk carriers, 62% are less than 10 years old, because if you remember, back in 2008, there was a big build out. But when you start looking at general cargo ships, 10 to 4, you're looking at 15 years and older. So how much cargo can be moved given the age of some of these, given the size of some of them, which again, is going to put more pressure on the underlying economy. Now, back to the point of the U.S. and Germany. When you start looking at trade, well, German PMI and PMI orders, you get an idea of kind of where that's going, and the global economy is turning quickly. The Russia's invasion of Ukraine driving additional headwinds into a potential recovery. But we also saw a sharp drop in Eurozone data coming and forecast recession since, we've been talking about a recession happening in Q3 since essentially the Q4 and Q1. But the one thing that has really started to catch people by surprise is that big drop in the U.S. And that's the one that is starting to drive, are we going to get deflation sooner? And that's what we're going to talk about in segment 2. So then when you start looking at some of the growth tax, if you will, or some of the pressure points within the U.S., you get an idea that the S&P 500, those EPS estimates are going to come under pressure. It doesn't mean they have to drop instantly. It just shows you the trend in which we're going, and the sector and the corporate profits versus the CEO confidence. CEO confidence coming down as the leading indicator. They're trying to keep prices elevated in order to protect kind of where some of these are going. But again, how much can you pass through? How much can be retained? And those are things that we're going to talk more about in the next 4 segments as we go through some of these underlying problems in really all corners of the world.